Today we're going to learn about the keys of candlestick trading. And once again, this is the Beach Trader, and we want you to live a freedom lifestyle. Candlestick trading content. Number 1, the history. Number 2, basics. Number 3, body. Number 4, understanding patterns. Number 5, candlestick versus bar graphs. And number 6, live chart. Number 1, history. Rice trading had been established in Japan in 1654, with gold, silver, and rapeseed oil following soon after. Rice markets dominated Japan at this time, and the commodity became, it seems, more important than hard currency. Manhisu Hamu, a Japanese rice trader born in the early 1700s, is widely credited as being one of the early exponents of tracking price action. He understood basic supply and demand dynamics, but also identified the fact that emotion played a part in the setting of price. He wanted to track the emotions of the market players, and this work became the basis of candlestick analysis. He was extremely well respected to the point of being promoted to samurai status. The Japanese did an extremely good job of keeping candlesticks quiet from the Western world, right up until the 1980s, when suddenly there was a large cross-pollination of banks and financial institutions around the world. This is when Westerners suddenly got wind of this mystical chart. Obviously, this was also about the time that charting in general suddenly became a lot easier due to the widespread use of PC. In the late 1980s, several Western analysts became interested in candlesticks, and the future was set. Number 2, basics. Candlesticks are important to your trading analysis because it is considered as a visual representation of what is going on in the market. By looking at a candlestick, we can get valuable information about the open, high, low, and the close of price, which will give us an idea about the price movement. Candlesticks tend to form patterns which are interpreted by traders to identify a continuation or reversal of the existing trend. It is also used to spot short-term trading opportunities. Different traders make use of candlestick charts differently. Candlestick patterns should be used in conjunction with the prevailing trend. Candlesticks also tend to act as a unique leading indicator, providing the trader an edge while entering and exiting a trade. It also gives an early signal of a reversal in trend compared to the rest of the technical indicators. Hence, it is widely used in short-term trading and in volatile markets. Candlestick complements most of the other technical analyst indicators and works well with the Western technical tools. Candlestick patterns also tend to act as support or resistance level and indicate the start of a pullback or bounce. Candlesticks are flexible. They can be used alone or in combination with technical analytic tools such as the moving average and the momentum oscillators. They can be used also with methods such as the Dow theory or the Elliott wave theory. A personal use candlesticks will support and resist trend lines and other technical tools. The human behavior in relationship to money is always dominated by fear, greed, and hope. Candlestick analysts will help us understand these changes in psychological factors by showing us how buyers and sellers interact with each other. Furl said, the speculators' deadly enemies are ignorance, greed, fear, and hope. All the statute books in the world and all the rules of all the exchanges on earth cannot eliminate these from the human animal. Candlesticks are used by most professional traders, banks, and hedge funds. These guys trade millions of dollars every day. They can move the market whenever they want. They can take your money easily if you don't understand the game. Even if you can trade $100,000 trading account, you can't move the market. You can't control what is going on in the market. Using candlestick patterns will help you understand what the big boys are doing and will show you when to enter, when to exit, and when to stay away from the market. Number 3, body. Each candle represents the price movement of a stock, a market, a cryptocurrency, or a currency, etc. within a period of 1, 5, 10 minutes, 1 hour, 1 day. It could be any period that you basically change to. The periods available will change according to the platform. And so let's talk about now what the candle means. So the open price shows the price of the stock when the market opened. Notice that the bullish candlesticks, the open price, start where? At the bottom. And the bearish candlesticks start at the top, right here. The close price shows the price of the stock when the market closed. Notice that the bullish candlestick, the close price, starts at the top, and the bearish candlestick starts at the bottom. The highs show how high up the market was pushed, showing the highest price it reached during that day, which would be the same on both sides. The lowest price shows how far down the market was pushed, showing the lowest price it reached during the time period. The body. The body will change in length according to the open and closing prices. The stick or the body is colored, sometimes black or white, or green and red in this example, and is more modern charts. Black or red sticks represent a bearish stock, decreasing market. This is what we're talking about right here, which means that for the period, the market closed with a lower price than it opened. White or green sticks represent bullish stocks, increasing market, which means that the period, the market closed with a higher price than it opened. Upper shadow is a line, the wick or the tail sticking out of the body or top of the candlestick, and it shows the length in which the stock traveled upwards. So this is the upper shadow, and it's going to be the upper shadow on both of them. The lower shadow is a line, the wick or the tail sticking out from under the body of the candlestick, and it shows the length in which the stock traveled downwards or the currency. Understanding patterns. Number 4, bullish engulfing. This pattern is characterized by a large green body engulfing a prior smaller red body, which appears during a downward trend. The green body does not have to engulf the shadows of the prior candle, but it totally engulfs the body. The market is characterized by an existing downtrend. A red body is observed on the first day or the first time frame. The green body is formed on the second day, completely engulfing the red body of the prior trading period. Bearish engulfing. This pattern is characterized by a large red body engulfing the prior day's smaller green body, which appears during an uptrend. The red body does not necessarily engulf the shadows of the green candle, but totally engulfs its body. The market is characterized by an existing uptrend. A green body is observed on the first time. The red body that is formed on the second day completely engulfs the green body of the preceding day. Harimi. This pattern consists of a green body followed by a small red body candlestick that is completely inside the range of the green body. The market is characterized by an existing uptrend. A green body is observed on the first trading time, and then the red body that is formed on the second day that is completely engulfed inside body of the first day candlestick. Dark cloud. This is the top reversal pattern with two candlesticks. A green candlestick appears on the first day while an uptrend is in progress. The second day, or the second trading time, opens at a new high with a gap up and closes more than halfway into the prior green body, leading to the formation of a strong red candlestick. The market is characterized by an existing uptrend. A green candlestick is observed on the first trading time. A red candlestick appears on the second trading time with a gap up and closes more than halfway into the body of the first day. The second day fails to close below the body of the first day. About is the rising sun or raising sun. It's a bullish pattern where price looked like it was going to continue down, but then moved up suddenly. So these are the top 5. And everybody should know these. These are great enter and exit points. Number 5, candlesticks versus bar graph. Candlesticks provide more valuable information than bar charts. Using them is a win-win situation because you can get all the trading signals that bar charts generate with the added clarity and additional signals generated by candlesticks. And you can see right here, you can just see more. You can see if it's going up or down. You can see by the color formation, you're just getting more information than the regular bar charts. And that's why people tend to use candle charts and candlestick charts more than any other way of trading. So now we're going to go to a live chart and we're going to explain exactly how this works, and we're going to talk about the time and the different factors that the candlesticks charts allow you to have. So now we're going to go to DailyFXcom. They have free charts for us, and we're just going to hit the charts. This is the euro versus USD today, and this is the candlestick chart. Now this is the bar graph chart. Do you see the difference? We can color code it any way we want to, and this is just the line chart. Okay, we're going to go back to candlestick because there's more information. You guys can see these bright red and bright green candlesticks. These are going to help us trade. So right now it's on each day. So each candlestick represents one day at a time. So we could change this to anything by clicking right here, and we can change it to, 2 days, 3 days, hours. Let's go look at 1 minute. So this is 1 minute. So each candlestick right now represents just 1 minute, 1 minute of time. Now we could go to 5 minutes of time. Most of our trades in high frequency Forex are 1 to 5 minute trades. So we can switch to 5 minutes and see exactly what happened. Do you see the wick that this created right here on the last one? Do you see the wicks where it's going up and down and the body is little most of the time here, and then here the body is big, right? So let's go back to 1 minute and look. We see again the wick. We see different trends and different patterns. 30 minutes, we can look at 30 minutes and see what we got going. Now, it's advised to look at different time frames for you to get the right amount of time in your trade. So if you're doing 1 to 5 minute trades, guess what? You need to sometimes look at 30 minutes and an hour and a day, different times, so you can know exactly what's going to happen, so you can predict what's going to happen next. So let's go back to 1 minute. And if we're trading 1 minute, we're saying right now, look how high it went on this wick, right? It went down first and then it went back up. So what kind of trend are we in right now? Well, we started out right here and we're moving in a downward trend. That's in the minute. Now let's look at the hour. What kind of trend do we have? Well, in the hour, it looks like the last time the trend is going up. But before that, the trend was going down. So do you see the different information we're getting? If we look at the day, this is the day. So we're in a downward trend, and we just started going in an upward trend during the last couple days. This is probably like a week. 1 day, 2 days, 3, 4, 5, 6, 7. So this week right here in 7 days, it started a downward trend and it started going up, and now it's going back down. So you can predict things way better when you look at it like that. You could also look at, a week. See what a week did. Well, in this, it looks like it was mostly going up, and now it's in a downward trend for a couple weeks. 1 week, 2 weeks, 3 weeks, 4 weeks. This is a month. It's been a downtrend for almost a month. Last week it was going up, but now it looks like this week is going back down. So this is what you're going to get out of candlestick trading, and it's very beautiful. It's very unique, and it's probably the #1 way that you should trade. Now you can use indicators with this. Let's just go to the Bollinger Band, and I'll show you how you can predict what's going to happen next and when the resistance is going to happen and when the support's going to happen, right? So let's go back to 1 minute and let's look. So right here, when it hits the top of the Bollinger Band, we knew it was going to go down. It went a little bit, it broke through, but it went back down. So we could trade on the bounce really good with the Bollinger Band and the candlestick, because we know when it goes through, it's going to eventually go back up. It hit the support right here, even though it kept on wicking down, down, down. But before the trades was over in the minute, it started back up and it went up. It hit the moving average in the middle line, right? And it can keep on going up or it can go down. But what we wanted to do is be in a trend either going up or down so we can make money. It's better to, when you want to make money, if it's in an upward trend or a downward trend. You don't like it when the market is consolidated, like right here. It's starting to not move up or down too much in a minute. So that's a place where you can lose a lot of money. We want to either trade on a upward trend and we want to get a call, or we want to trade on downward trend and we're looking for a put. You guys, thank you so much. This is the Beast Trader signing off. I'm glad that you guys learned a lot from this. And you guys, please trade with a candlestick, but you need to know what you're doing. It's very valuable. Okay? You guys have a great day.